2021 market crash. How can you be prepared for the recession? Hello, folks. Welcome back to the Motivational Entrepreneur channel. Let's begin our video today. We are here to discuss how to be prepared for the market crash. Make sure to stay till the end of the video, since this can help both the amateurs and the business experts a lot. So let's begin. Basic information of market crash. A market crash is a social phenomenon. It is a human spiral by economic events and behavioral psychology. Market crashes can happen because of 4 factors. They are: 1. Most of the stock market prices can increase for a long time. 2. Every investor can overly think optimistic for the future. 3. The profit ratio of the market is high when we look at historical averages. 4. Investors can borrow money to buy shares at a high debt-equity ratio. Government regulations are also a reason for the market crash. In market crashes, investors spend too much of the amount in the market. Why the stock market crashes? A crash occurs when stock values drop dramatically in a few days. This may occur in the market, but it is most common following extended periods of high-price success. Investor panic, which is generally triggered by external economic or political events, can spiral out of control, with selling pressure leading prices to plummet. For example, in February 2020, the stock market plummeted as the fast spread of COVID-19 lowered investors' confidence in the global economy. The anxiety was heightened when the market collapsed, resulting in further sell-off in March. No longer all stock market crashes are as straightforward as 2021. However, they all have one thing in common. Traders panic and sell due to the fact they fear the market will keep losing. That creates a vicious cycle and a self-pleasing prophecy, however, handiest for a brief length. Make a strategy and keep some money aside. Although no one enjoys a market slump, it is unavoidable at times. It's also natural for markets and economies to go through ups and downs. Every bull market will almost certainly be followed by a bear market. Every bull market we enjoy will almost certainly be followed by a bear market at some point in the future. As a result, it's critical to have a strategy in place. Every investor faces the possibility of a big economic catastrophe, no matter how remote. It has happened in the past. It has the potential to happen again. Because a stock market crash is virtually certain, it's critical to consider what you might want to do if one occurs. You may start putting some things in place right now to assist you to stick to the plan. You could, for example, wish to keep some cash on the sidelines. If the stock market fall coincides with an economic slump and probable job losses, that money may be utilized as an emergency fund. You might also put that additional income to good use by purchasing stocks at a discount. Make sure you understand your investments. To conclude that if an investor buys individual stocks, make sure that you are buying for a good reason. Don't buy the shares which you heard from any random source. Before investing, you should first research a company's profile on your own. That will help you understand whether your money should go into it or not. Truly understanding your investment help you assess the stocks on your own in bad and good times. In case you need to maximize a lengthy term increase, you must put as much money as you could into numerous institutions of stocks. Few, if any, funding options have proven a consistent history of outperforming the stock market. However, part of that funding plan must be an expectation that you will every so often see 10%, 20%, or maybe 40% of your wealth disappear on paper for a few periods of time. If you plan on retiring soon and also you want to keep extra capital, then you need to grow your financial savings. That ought to be part of your plan. Holding an assorted portfolio of assets with bad fee correlations will reduce the impact of an inventory market crash on your overall portfolio. However, it comes at the fee of decreasing the expected lengthy-term boom. Hedge your bets. If you anticipate a significant slump coming, don't be afraid to position yourself to profit from it. There are numerous options available, and the optimal one for you will be determined by your risk tolerance and time horizon. If you hold shares in a company that you believe will decline, you may sell it short and then purchase it back when the chart patterns indicate that it is likely approaching the bottom. When you already own the stock you're intending to short, it's a lot easier. You may simply deliver your shares to the broker and pay the difference in price in cash if the market swings against you. An inventory marketplace crash is also inevitable, so it's essential to reflect on consideration on what you may want to perform while one takes place. You can put a few matters in the area now in order to help you comply with the plan. For example, you could want to have some more money on the sidelines. That cash might be used as an emergency fund if the stock market crash coincides with an economic downturn and potential task loss. You could additionally put that more money into paintings by buying stocks after they've come down in rate. Take a flight to safety. When there is significant market volatility, most professional traders switch to cash or cash equivalents. If you have time before the crash, you might wish to do the same. If you leave fast, you'll be able to return at a considerably reduced price. When trend ultimately reverses, you'll be able to benefit even more from the increase. Don't be scared to profit from time to time. It's fine to make gains on investments that have performed exceptionally well, but in which you no longer have confidence. It's also better to do this while the market is at its highest. You'll have locked in some hefty profits, even if you lose out on future gains. Diversity. Diversifying your portfolio is arguably the single most essential thing you can do to protect your money in the event of a severe bear market. It may be fair for you to invest the majority of your retirement assets in individual stocks, stock mutual funds, or exchange-traded funds, depending on your age and risk tolerance. However, if you perceive a crisis approaching, you should be prepared to shift at least a portion of that money into something safer. Stocks, bonds, cash, real estate, derivatives, cash value life insurance, annuities, and precious metals are just a handful of the assets available to individuals today, each with its own level of risk. Getting out of debt. If you have a lot of debt, you could be better off selling part or all of your possessions and paying off your obligations if you anticipate severe weather coming. If you have a lot of high-interest debt, such as credit card bills or other consumer loans, this is especially wise. While the bear market rages, you'll at least have a pretty solid balance sheet. It's also a good idea to pay off your house or at least a significant portion of your mortgage. It's never a bad idea to reduce your monthly commitments. Conclusion. We hope we have helped you realize that it is better to be ready for the problems ahead. You need to play your cards right at this moment and make sure you don't lose your savings in the recession. We hope you liked this video. Hope we see you in the next video. Also, don't forget to subscribe to our channel and drop a like on this video. Bye! Have a great time ahead!